So let's start with inventories today. Now, this is actually a very long chapter. Okay, there are a lot of things which are given in the prerequisite readings, but we'll not cover everything. Okay, we will cover the ideas which are mainly relevant from the point of view of course, the CFA readings, but also as an analyst, because the later parts, what I feel is, it is more from a person who's going to prepare the statement, not from the person, not from the perspective of the person who's going to analyze the statement. So we are, and throughout the curriculum, we have to focus a little more on the analysis part. So wherever there will be situations where core preparation will be discussed, and a lot of details which are maybe sometimes they may also be important from an analyst point of view. But if suppose those ideas are again revisited during the core readings, and if we feel that these should be discussed that time, so we will discuss those concepts during the core readings only. Okay. So if you see, actually, this is actually a slide. If I think it's this actually 40 or 45 slides, I think this PPT is. But we'll be covering till the part where we are seeing variations in the inventories and cost of goods sale using different methods. Okay. And also, we just try to create a practical example today, hands on. In the class, we'll do it together. Okay. We don't have any Excel template as of now, but we can actually discuss and we can do it together in the class today. Okay. So that will be more important from an analysis point of view. Okay. So let's start. So what is the role of inventory? Inventory is sold course to generate revenue and profit. Okay. So it is not just something which is just sitting in the warehouse. Okay. It actually, you can say, just like you collect a pool of securities, it is like a pool of goods which the company is expecting to sell. Okay. And those sales are actually converting your operating activity into revenue and, of course, profit. Okay. So when you are talking about the inventory, you are talking about the core input first. Okay. Which becomes the product and then it becomes the sale, something like that you can think of. Okay. It is actually a significant asset in the balance sheet. Okay. And most often it is, especially if you talk about firms which are manufacturing firms. Okay. So for many companies like these manufacturing firms, the inventory is a significant asset because, see, it actually ties up a lot of capital with it, right? A large amount of capital is tied to inventory. So it affects a lot of things. It affects your liquidity, it affects your working capital, and your overall operational flexibility. Okay. So if suppose inventory is not stated properly, okay, or if it is not even measured properly, then it is possible that the balance sheet and the very important ratios that we actually use for analysis, they will be misleading. And I think this is more important in the context of comparison, because even if suppose there are two three companies whose operations are similar, but their inventories are measured differently, or maybe they are misstated for some firms, then even the operations will be similar, but still you will find that the ratios, the numbers, they look very, very different. Okay. Now let's start with classifications. As I said, we first discussed the category of manufacturers. Okay. So basically, the idea of manufacturers starts from raw materials. So raw materials are the basic inputs which are purchased from suppliers. What kind of inputs we can have? What kind of things we can have as inputs? We can have different kinds of components, auto parts, chemicals, metal parts, electronic parts. A lot of things can be there. Even fabric, cloth type parts. So raw materials, basic inputs which are purchased from suppliers, but before any production work has been applied to that material. So that is your raw material. Okay. So at this stage, even though it has some inherent value since it has been purchased from some supplier, but internally, if you see inside the firm, value has not been added till now. It's still a raw material. Okay. So raw materials will reflect your earliest point in the production process. Then you have work in progress inventory. Work in progress inventory is that inventory which has actually entered production. Okay, uh, some things have been applied, some labor costs have are involved. Okay, some amount of overhead has been applied. Okay, and some amount of transformation has been done, you can say. Okay, using labor or other things. Okay, but still the product is not complete, right? It's still work in progress. It cannot be sold. Okay, so this is a category of inventory which will capture that kind of inventory, which is, although it is consuming resources actively, but still it is not ready for your revenue generation. Okay, it's not a saleable output, you can say, as of now. Okay, and then comes the third category, which is finished goods. So completed products, finished goods that have gone through the full cycle of production. Okay, and they are uh, they are packaged, they are made ready, and they are completely available for sale. Okay, so these finished goods, they are the final stage, complete final stage. Now let's come to the second category of you can say sub classification. One is for manufacturers, then you have the subtypes for merchandisers. For merchandisers, we'll actually have no raw material or work in progress. Okay, for traders, for merchandisers, you just have finished goods. They are ready for sale. Okay, so if suppose uh, you are a retailer, okay, you have your inventory which is ready for sale. Why I'm saying is because as a retailer, yes, you might do some light activities, you might do some tagging, tagging of prices, some arrangement, shelving, putting it in plastics, bundling them. But does it change the nature of that inventory? No, of course not. So that's why it is ready for sale. Okay. And it is directly purchased from suppliers. Okay. Or manufacturers, you can say. Now let us come to valuation methods. And the perspective of the analyst will say we have costs which are allocated between ending inventory and cost of sales. Now, this is very, very important. We have to understand what inventory actually represents and how the costs can be reported of inventory. Okay. How will you allocate costs? So, what it represents, we have seen. Okay. We have seen the classifications also. Now, with respect to cost, you have in the income statement, if you remember, you have the cost of goods sold, right? That is one aspect, cost of goods sold or cost of sales, you can call it. But that is not the total cost of goods which is available for sale. So, total cost of goods which is available for sale, that cost will be allocated between these two items, the ending inventory on the balance sheet and the cost of sales on the income statement. So, total cost of goods available for sale, okay, overall is the same. Maybe the allocation might be changing here and there, okay, between the balance sheet and the income statement. Okay, and different methods will reduce comparability across firms and time. So if you have different valuation methods, obviously they will produce significantly different amounts of ending inventory also and cost of sales also. Okay, as I said, even sometimes the underlying operations might look similar, still their numbers can appear quite different. Okay, and because the numbers might appear different, the balance sheet strength also can appear different. Okay, so you have to, as an analyst, you have to uh, make sure that you know the method which is being used. Okay, so that you can compare the numbers and the trends across firms and time. Okay, now we have IFRS and US GAAP. So IFRS allows specific identification, FIFO, first in, first out, and weighted average cost method. US GAAP allows these three plus another method, LIFO, last in, first out. Okay. So we will see these in detail in subsequent slides, but I just want to give a quick intro right now. Specific identification means you are assigning the actual cost of specific units to sales and inventory. Okay. FIFO means this FIFO, first in, first out. I mean, as the name itself, it's quite clear that older costs, okay, will be assumed to flow into the cost of sales first. So basically, the assumption will be that the inventory which came first is also going out first, is also getting sold first. Or you can just take a weighted average of all the costs spread across the entire inventory. Then, of course, last in, first out. So most recent ones, the most recently bought inventory will be assumed to be sold first. Okay. So we'll see what is the interpretation for the analyst in subsequent slides and the difference also in detail. Now, of course, there are notes which will disclose notes to the financial statements which will disclose the method and composition for the interpretation of the ratios. Now, let's start with uh, what kind of costs should be included in the inventory. If you remember in the last chapter, even though long-lived assets was the sixth chapter of FSA of prerequisite, we have covered it in the last class, but the same idea we discussed in long-lived assets also, that what kind of costs we should include. If you remember, we talked about we talked a lot, we discussed a lot about the exam about the storage costs, the transport costs, the costs which are actually used even inside a premises to repair the premises so that the long-lived asset can be installed there, right? And we discussed that if suppose that cost is directly related to the setting up of the long-lived asset, then that cost should be included in the cost of long-lived asset. So it was company specific. If you remember, we discussed it. That same machine maybe in another company might not require that kind of floor repairing. So that cost also can be sometimes company specific. Okay. So over here also we have to discuss that what are the principles that we need to follow. So inventory should include ideally just like long lived assets, the purchase costs, the conversion costs, and transport costs which are required to bring the inventory to its present location and condition. That is what we discussed, remember, in the last class. So let's start with purchase costs. So purchase cost is not just the invoice price. You have purchase price, okay, plus taxes, duties, okay. The transportation cost is actually included in the purchase cost. Okay. Discounts also, they will also be netted off actually. If you can get some cash discounts or trade discounts or volume discounts or rebates, anything like that, they can also be netted off. Okay, but what are included? Duties, transport, insurance costs are included. Handling costs are included. Okay, and if you get any trade discounts, immediately in the purchased cost only, you have to subtract it to reflect that, okay, this was your purchased cost of the inventory. Next, you have conversion cost. So conversion cost can be direct labor. Okay, the costs which are involved in transforming the materials into the finished goods. So direct labor, production related overhead, okay, fixed and variable overhead, okay, production related expenses. Then other costs to bring the inventory to present location and condition. Okay, this actually, there is a subtle difference between the other cost category, especially if we say the definition cost to bring inventory to present location and condition. You might be thinking that this is same as the transport cost. But when we talk about purchase cost, when we include transport cost in the purchase cost, we are actually talking about the raw material, okay, which was actually bought, or the intermediate good which was actually bought from somewhere, and then it is brought to your place where it will be channelized. The labor will be applied, production overhead will be applied, and it will be converted. Okay. But when we talk about other costs, let's say you have uh, to bring your finished goods also to a certain place so that it can be sellable. That will be included in the other cost. So that transport cost, the initial one, and this cost to bring inventory to present location and condition might look similar, but they apply to different times and different kinds of goods. Okay, in the same inventory. Okay, it can be finished goods. It can be finished goods for this the last category, other cost, and it can be raw materials for the first category, the transport cost. Okay, so there is a subtle difference. Now, if you see the principles, both IFRS and US GAAP, they actually require capitalizing costs which are necessary to prepare the inventory for sale. So, whatever is required, that is the principle. Whatever is required to bring the inventory or to prepare the inventory for sale, to bring it to sellable condition, that has to be capitalized. So, what is the meaning of capitalize as we discussed in the last class? Capitalize means in the context of statements, what does it mean? Will it hit the income statement immediately? Okay. Vivek has asked a question, I think. What cost can increase the life and efficiency? Lot of cost can increase the life and efficiency. See, different kinds of goods can be there, right? If suppose you have, let's take a very simple example, Vivek. Let's say you have a automobile part which is being sold, okay? And there can be different categories. Now, if suppose you actually apply certain kind of ceramic coating or any kind of, a coating which actually increases the life of the paint or which improves uh, the metal in such a way that the scratches will be less. Okay, Vivek. So that kind of cost which is being applied overall, that kind of coating or cost, okay, whatever is being applied, that is increasing the life. It is making it better. Okay, so it will apply to different kinds of goods. Efficiency wise also you can have actually the same ideas. I mean, we can take very basic example in terms of efficiency also. Let's talk about electronic systems. Okay, the more cache memory they have, the better the efficiency will be. And of course, that will be reflected in the cost as well. So obviously that will be higher costs. And that's why we see different grades of equipments, electronic equipments also. Got it? Vivek, is it clear? So these kind of costs can increase the life and efficiency. So my question was, what is the meaning of capitalization? Will it hit the income statement immediately? Correct. Absolutely correct. It will not hit the income statement immediately. Capitalization means they will be in the balance sheet as an asset, but they will become an expense only when the inventory is actually sold. Okay, of course, through the cost of sales. So, capitalization, as we discussed in the last class, it is delaying your recognition of the expense until your the corresponding revenue is actually recognized. Okay, so that is the idea. Okay, so is this slide properly clear? Because this is an important slide. Is this clear? What are we up to? What are we including in the costs? Okay, fine. Now, what costs are excluded from the inventory? First is abnormal waste. So, materials, labor, or production waste beyond normal levels. Okay, so normal scrap, you say we call it scrap, right? That is just a part of production. Okay, normal scrap is a part of production, but any kind of abnormal waste will be treated as a, a period cost. It will be expensed immediately. For example, I don't know why I'm remembering this movie now, right now. I mean, have you seen that the first Batman Begins movie? Abnormal waste. I mean, I'm not very sure about the scene, but I think some a large just to make sure. I mean, when they were preparing that bat suit, then just to make sure that there is no suspicion. Okay, they actually order a very large batch of, I think, some raw material. I don't know the exact name of that raw material which was ordered. So it was ordered, and it was actually, they decided that no, there is a slight problem, regarding the angle or whatever. Again, I don't remember the exact scene. So there was a problem, right? So if suppose a similar thing happens to a company, that if they order something and they realize that now this is now waste, whatever uh, precision markers they were having, or whatever configuration they wanted in their intermediate goods or final goods using that raw material, that will not happen because of some alignment problem, let's say. Okay, and it is non-refundable, non-returnable, and it cannot also be used anywhere else. Okay, maybe it has some scrap value, maybe it has some residual value. They will sell it, but still there will be a loss. So will that loss be a part of your inventory cost? Think about it. Should that loss, that loss which actually happened because of a judgment error or whatever, maybe the people who actually ordered it, they were not smart enough, or if they were smart enough, still this thing could not be tested unless the inventory was actually in place. So that cost is an abnormal waste. Okay. So is it clear what is an abnormal waste from the context of the company? And that abnormal waste, you cannot double the cost of it. Let's say you ordered one full batch and that full batch is wasted. Then you cannot claim that, okay, the cost of now this inventory includes two batches now. One batch which will be used and one batch which was wasted. No, the batch which was wasted, it will not be under cost of this inventory. Okay. It will directly go as an expense. Okay. As a loss under the income statement. Okay, so abnormal waste will not be included in the cost of inventory. Then you have the next category is storage costs. So transport costs are included, but storage is excluded because, see, storage does not transform the inventory or bring it to any other location. Okay, except for the fact that maybe storage can be required as a part of the production process. If suppose there are cases where storage itself can be required as a part of the production process. Can you give me some examples where it can happen? Any example you can think of where, as a part of the production process, that storage is important. You have to keep it to make it better, let's say. I mean, any example where just storage makes the product better, if that example has to be taken, or transforms the product in some way. Because in most of the cases, you have storage which actually makes things worse, right? Correct. Correct. Beverage company, right? It actually stores food. But see, there's a problem, Vivek and Karthik, with the idea is that, see, mold actually makes it worse than the mold actually is not. Is it a product which is being sold, Vivek? I mean, I was thinking of something else. I was thinking of actually a similar idea, but in a very different context, with but not with mold, because I'm not very sure about mold. Is mold actively manufactured or sold? Is there some category of mold? Because mold grows and it spoils a lot of things. That is what we know about mold. I have no idea what kind of reference you are making over here. So you can be just elaborate, and I'll then explain. And Karthik, you said beverage company stores fruits, but again, with time, do the fruits get better? Okay, so yes, you can say that maybe if underripe fruits were part of the inventory initially, and that fruit now does not require the support of a plant, just by storage itself, it can become better. So yes, that will be an example, but not always, Karthik. Is it clear? Okay. And what I was thinking in the context of, say, we the wines which are sold, right? We've all heard of this term that nothing ages like better like as wine, right? So wine companies deliberately, they have to store wine for long periods so that it can be sold at a higher price. Agreed? Because the selling price goes higher, the quality changes with storage. Okay, so that can be one example. Got it? So I was thinking on those lines. Okay, fine. Then you have administrative overhead. Now, again, just like the last class, we discussed that if you have administrative overhead and selling cost, they will not be a cost of the product. They will just relate to running the business and generating sales. Okay, not to preparing inventory for sale. So obviously they will be just expensed as they are incurred rather than being capitalized, rather than being included in the inventory, okay, in the balance sheet. So all these costs are expensed immediately on the income statement. Now let's discuss why the method choice matters. So inventory costs obviously change over time. You can have periods of inflation, you can have periods of deflation. In general, also, even without a general inflation or a general deflation, even without that environment, the price of inventory can change. Okay, because of different kinds of shocks, also because of different reasons, also. Now, the method which you select will determine the allocation to cost of sales versus ending inventory. So, whatever method you choose, that will determine how much of your cost will be allocated to ending inventory. Okay, and how much will be allocated to cost of sales. So, basically, how much will be capitalized in the ending inventory and how much will be expensed and when it will be expensed. When is also important. So, think about it. If suppose the cost of sales becomes higher, what will happen to the profit in that particular period? If suppose the cost of sales is higher, what will happen to the profit in that particular period? Correct. Profit will decrease, margin will decrease. Correct. More cost to cost of sales will lower the gross profit and net income for that period. Okay. And it is also important to understand that cost flow assumptions, they can differ from physical inventory movement. Okay. So physical flow is different from cost flow. You'll see that many products, they physically move in one pattern. But these methods which we discussed, FIFO, weighted average, LIFO, all these are cost flow assumptions. Okay, they are rules for assigning the costs to units sold and units remaining. Okay, which means that the cost allocation, it can actually be different from the actual movement of goods. And of course, if the prices are stable, then the impact of whatever method you are choosing will be minimal. And that we'll see today in the example. So let's discuss specific identification method. Okay. Now, specific identification method, it is used generally when the inventory items are generally non-interchangeable. So each unit is different and the firm can identify exactly which item was sold. As you can see in this diagram only. This is one of the best examples actually. Different gems. Okay, they can be specifically identified. Okay, ultra luxury items which can be specifically identified which one has been bought and which one was sold. Okay, so they are non-interchangeable. You cannot just change this gem with this gem for reporting purposes only. Now, since they are differentiable, okay, the company can track actual historical cost attached to each specific unit. Okay, so this cost which is going to be assigned to the cost of sales is not based on any assumption. It is actually the real cost of the exact item that left your inventory. Okay, that is why this method actually, it actually matches your physical flow to cost flow. So FIFO, weighted average, and LIFO, they are not matching it. In case of FIFO, LIFO, and weighted average, just like we discussed earlier, they are just cost flow assumptions. Okay, and in those cases, the cost flow will not be same as the physical flow of inventory. Okay. Now, of course, it is common for expensive and unique goods, as I said, in these kind of examples, precious gemstones, because each stone is different, right? In color, size, quality, transparency, clarity, a lot of things are there. Okay. So it makes a lot of sense to track the costs of each item by item, you can say. You cannot average across units. You cannot do LIFO or FIFO. Okay. Now, what are the typical application? Yeah, precious gemstones, custom manufactured goods, one of a kind designer items, and high value equipment. Now, let us come to first in, first out method. So, FIFO or first in, first out method. So, what is the assumption? You assume that the oldest goods which are purchased, they are sold first. The oldest inventory which is purchased is the first inventory which is sold. Okay. Now, since the older units are assumed to be sold first, of course, the cost of sales will reflect the oldest inventory cost. Okay, because that is what is being assumed to be sold first. So your cost of sales will be based on these older historical costs, which is going to start from the beginning inventory. Okay, the earliest purchases. Got it? What about ending inventory? So whatever is left in ending inventory is assumed to be the most recently purchased unit. So the inventory balance on the balance sheet for ending inventory, it will reflect the most recent costs. Okay. So what is the important point for FIFO? Important point is that, sorry, important point is that the older costs which we are having. So I just take a note over here. It could be better, I think. So when we talk about FIFO, in case of FIFO, so older costs are going here. To the cost of sales. Okay. And newer costs are, I think there is a problem with the mapping of the pen. That's why the handwriting is a little uh, too stretched. Give me just 1 minute. Just 1 minute. We check once. Yes, I think it should be better now. Newer costs. And so older costs are going to, yeah, now it's better. The income statement. And the newer costs stay on the balance sheet as ending inventory. So I think this is important. Okay. Now let us come to the, and this is the Excel that we are going to try and build today regarding the different, cost methods, what kind of results they can produce. So now let's move to this weighted average cost method. So basically we are trying to use a single blended cost. Okay. For that particular period, we are not tracking the specific costs, or we can say cost layers, because specific identification also we are not doing. Even cost layers we are not tracking, like FIFO or LIFO. Okay. So the calculation, of course, will be very simple. Total cost of goods available for sale divided by the total number of units available for sale. Straightforward calculation. Now, when we say goods available for sale, so goods available, they actually include this, sorry, they include the beginning inventory plus whatever you purchased and of course the conversion costs. Okay. So total cost which is sitting in the system for that period. What it includes? It includes the beginning inventory. Obviously, it will include the beginning inventory. Okay. Plus whatever you purchased and converted during that period. So whatever costs were added during that period, mainly what will be those costs? Purchase costs and conversion costs in a manufacturing setting, of course. Okay. Now, what is the application? See, once the average cost per unit you have already calculated over here, this same cost has to be applied consistently for both. For cost of goods available for sale, it will apply to units sold and it will apply to ending inventory, of course. Okay. Now, since it is actually kind of blending the costs, the old and the new together, okay. So they are weighted average, right? So that is why their cost of sales and ending inventory values, they will be typically between FIFO and LIFO. Okay. So basically the results will be moderate, you can say, in terms of as compared to FIFO or LIFO. Cost of sales and ending inventory will be much more moderate, and you can say less sensitive also to the timing of purchases, especially when prices are changing, either increasing or decreasing, and we'll see it through an example. Okay. Now let us come to LIFO, the last in first out method. What did we discuss? It is permitted only under what? Which standard permits it? Correct. It is only permitted under US GAAP, not under IFRS. Okay. So the assumption is that the newest goods which are purchased, they are assumed to be sold first. Okay. So last goods which are added to the inventory, they will be treated as the first goods which are leaving your inventory. Okay. And because of that, tell me, cost of sales or cost of goods sold, will they be reflecting the recent cost or the old costs? The cost of goods sold, will they be a representative of the most recent costs or the older cost? Think about it in LIFO. What do you think? Very good, correct. The cost of sales should reflect the most recent cost. So the units that are assumed to be sold first, okay, they are carrying the newest cost layers. Okay, so the expense which is recognized in that period will be based on the current purchase, or you can say near current purchase, and of course the near current production cost as well. Okay, now what about in ending inventory? Ending inventory will be based on oldest cost or newest cost. What about ending inventory? Very good. Ending inventory will be reflecting oldest cost. Okay. So what remains in the end, in the ending inventory, is going to be made up of older cost layers. So the balance sheet now in this case, it will reflect cost from older period. So it is just the opposite of this. So in FIFO, older costs were a part of income statement through the cost of sales, but the newer costs were a part of balance sheet through ending inventory. In this case, it will be opposite. Okay, in this case, in LIFO, the older cost will sit where? Balance sheet or income statement? Older costs will sit where? Balance sheet or income statement? Correct. Balance sheet, right? Just this is the oldest cost, right? So this shit in the balance sheets. So they can ask an indirect question, guys. They can ask an indirect question. They may not ask a direct question that, ending inventory reflects oldest cost or newest cost. That you were able to answer easily. But what if they ask ending inventory sits where? Okay, or oldest cost sit where? Ending inventory, of course, sits in the balance sheet. Oldest cost sit where? That can be asked. Okay, because ending inventory is in the balance sheet. So since ending inventory reflects the oldest costs are in the balance sheet, and the newer cost sit on the income statement through the cost of sales. Okay. Okay. Now, how do we calculate the cost of sales, the gross profit, and inventory? See, if suppose the prices are changing, then of course the cost of goods sold and the ending inventory, cost of goods sold and cost of sales, I'm going to use interchangeably. Okay. So I can say COGS or I can say COS, cost of sales. I'm implying the same thing. So obviously it will depend on the method, and the that split is not actually fixed between the inventory, that is not fixed. So everything will change even if the sales volume is same. Multiple choices will change. Okay. So let's do an example which illustrates how the cost of sales, gross profit, and ending inventory differ on the choice of inventory valuation method. So let's just try and build an Excel. Now we can have multiple options. We can consider manufacturing firm or a trading firm. Okay. I think to make things simple, is the Excel visible? Is the Excel visible? So I think to make things simple, we should actually use a trading firm, because then in manufacturing firm we will have to add a lot of costs which are involved with respect to transformation of inventory also. So we just assume that we are talking about a trading firm. I think it will be simpler. So let's say you have a trading firm which purchases goods continuously. Okay. Not continuously, let's say periodically. Okay. Depending upon the requirements. So let's say in one financial year, okay, it actually purchased, say, 4 times. Okay. So purchase one will be, let's call it, say, we'll not call it inventory one, collection one, let's say. Yeah. What is the word we should use here? Or if something is coming uh, periodically, okay, let's say once every 3 4 months they are purchasing. Okay. But let's say we are considering interchangeable items, because if we were considering non-interchangeable items, then we would not be able to apply the FIFO LIFO method. Okay. Because then we will have to use the specific identification method only. So we are using the same interchangeable products, and the same interchangeable product is coming again and again. But collection seems like, it seems like unique to uh, that particular purchase. So what is the collective name that we can give over here? A collection of inventory, or what? It is coming it is coming regularly. What should we call it? Collection, purchase, segment, segment one, segment two, like that. Segment will also differentiate. I don't want to differentiate. Can you just search right now? Or if you don't remember, or you not figure out, just like I am not able to just figure out what word we should use, just search what word should we use for inventory which is purchased regularly. Okay. But they are interchangeable items. So a collection of what? I want a substitute for the word collection for non-interchangeable items. Sorry, for interchangeable items. Really sorry. For interchangeable items. For interchangeable items, I want a word. What should I write? Okay, I'll search it. No, 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 not that. I mean, what do I call it? In the production process or in a trading process? What do we call? We order goods in what? In I think batch will be right. Batches, right? Let us search. That will be better. Batches of goods, right? Uh, Substitute word for collection to represent inventory of interchangeable items, right? That is the idea. Interchangeable items. Spelling, I hope, is correct for interchangeable items. Okay. So what word we can use? Stockpile, stock one, yeah, stock one, batch, stockpile, assortment one, yeah. See, these words I was looking for. Stock or array, set one, batch one. Okay. So yes, I think stock one we can use, pool also we can use. Okay. Collection is not okay. I mean, it's given collection of screws. No, I don't want collection. Collection is not that direct, okay, where we are just wanting to clarify everything. So let's use the word stock one or batch one, sorry, batch one. Batch one, batch two, let's say we are having batch three and four. Four batches we are getting. Okay. So four batches we are getting. I'll not write the dates because that is another example that has to be discussed, when we do that perpetual and periodic methods. That is different. So dates and all are not important over here. So first will be quantity of goods ordered. So quantity. So in batch one, quantity in terms of units, let's say. So let's say we have 1,000 units in batch one. Okay. Uh, 2,000 units in batch two. 2,500 units in batch three. And let's say we ordered, say, 1,500 units in batch four. Okay. Then, of course, the price will be different. Okay. And I mean, assume that I'm having this in USD. So price in dollars, let's say for the first batch and per unit, let's do it per unit, price per unit, per unit. Okay. And when I say quantity, I refer to number of units. Okay. So let's do it together, guys. Please be active. Please help me out. Please give your ideas also to make it better. Okay. So yeah, we have quantity, we have price per unit. Then we have quantity and price per unit, right? So price per unit in dollars. Let me just make it a currency. Okay. Price per unit USD number, no, not number. Where is currency? Yeah, currency. So how much? Let's say the price is the $10 per unit. Okay. Okay. It is by default, it is taking as rupees. Okay. So I'll just format it to dollars. Okay. So dollar English. Yes. Let's make it dollars, $10. For this, let's have the second one. Let's have uh, say $8. Then let's have $7. Okay, and deliberately say I'm trying to make a consistent pattern because I want to show you the difference, right, between the uh, different methods. What will be the final impact difference? So if suppose I first have a deflationary environment, then an inflationary environment, the results may not be so obvious what we are trying to interpret. Okay, so interpretation uh, of the idea that we want, actually that will not be possible directly. Obviously this can be changed. We can you can also create an Excel sheet after the class where you can change the numbers and see how the results go. But first let's talk about a very clear cut pattern of a environment where prices are decreasing for every batch. Okay, so 7 and let's say 6. Okay, just to make it simple. So obviously the total cost in, again, USD will be how much? This will be equal to quantity multiplied by price. So we have $10,000 and then yeah. Okay, so next let's assume some numbers regarding the sales. Okay, sales, again, units. How many units were sold? Let's discuss that. So we ordered, and this also we are identifying. See, what are we writing over here? I'm telling you very clearly. We are writing that From batch 1, how many units were sold? From batch 2, how many units were sold? Like that. Okay, that is the meaning of sales. This is not about time. This is about the respective batch only. So let's say we sold say 1,000 units full from batch 1. Okay. From batch 2, let's say we sold 1,800 units. Okay. From batch C, we sold 2,000 units. And from batch D, we sold 1,000 units. Okay. We also have to assume a selling price. So let me just assume a selling price per unit. So selling price per unit, let's assume it to be the price is 10,876. Now let's assume that the selling price is $15 per unit. Okay. So this is the selling price per unit, $15. Now, if this is the sales, this is the selling price. Now let's start with the methods. So if I say costs, say under the first method, let's start with specific identification. Okay, FIFO, LIFO we'll do after that, because the base method is the specific identification method, right? Because it tells you exactly, it matches everything. Remember, it was matching the cost flow to the physical flow also. So cost under a specific identification method, let's call abbreviated as SIM, specific identification method. Now quickly tell me, what is the cost per unit under specific identification method for the first batch, for this first round of sale? Tell me. Will it be any different from the actual cost under specific identification? Under specific identification, will this cost per unit under this method be any different from the actual price? It will be the same. Exactly. Perfect. So the cost is simply the same. So is equal to same. Whatever is the price, that is your cost. Finished. So let me just drag it. That is the cost per unit. Now the selling price is 15. So if this is my cost, if I want to find out the revenue, so does it matter whichever method I use? Does it even matter with respect to my total revenue? Will it be the same or not? Think about this. See, the total revenue has to be the same. Why? Because the selling price per unit is the same, and this does not change under any method. The methods are about the cost. All these methods, FIFO, LIFO, specific identification, weighted average, they are about cost flow assumptions. They will not change any revenue. So total revenue, if you see under all methods, total revenue under all methods, under each method, let's say, this is how much? Total revenue under each method is equal to the total number of goods which are sold, which will be the sum of this. Let me just add over here just to make simple. So total sales is equal to the total number of units which are sold is equal to this 5,800 units are sold. Okay. So can you tell me, if I have to find out total revenue under each method, I should multiply which cell by which cell? Quickly, if you are able to see the Excel properly, if it is visible properly. But I think I will change the resolution. I think Excel, all the cells are not visible properly. Wait. . Is it better now? A little better? More number of cells are visible now on the right, even with the same font size, I think. Anyways, so I have gotten an answer. It is C8 multiplied by E6. Okay. So is equal to C8. Perfect. Yes. The price per unit multiplied by E6, which is the sale. Correct. So E6 multiplied by C5. So or C8 multiplied by E6. E6 multiplied by C8. I mean, because while calculating this total cost, I actually entered the number of units first just to make it consistent. I will just enter the number of units first, although it doesn't matter at all. So number of units multiplied by sales. So my total sales is $87,000, which actually remains same for all the methods. That is for sure. Okay. Now, if my total revenue remains the same under all the methods, then what is the total cost under specific identification? That is also important. So under specific identification, if I have to find out the cost for each batch, what I'll do, the number of sales which have been, the number of units which have been sold multiplied by the cost. So is equal to this multiplied by this, right? Drag it. And then I will take a sum of, so this is my total cost under SIM, specific identification method. Do you agree? Total cost under SIM. Okay. So if I want to find out the gross profit under SIM, if I want to find out the gross profit under SIM, so gross profit under SIM, can you tell me how will I, which two cells will I subtract? Be very attentive. Okay. It will help you actually. Which two cells should I subtract to get the gross profit under the specific identification method? Quickly. To get the gross profit under S specific identification method, C10 minus G6. Okay, correct. Total revenue minus the total cost. Correct. Okay, so this is what we get as the gross profit under the specific identification method. Okay, fine. Now, gross profit is done under specific this identification method. Ending inventory. Okay, in fact, let's come to ending inventory under specific identification after some time. Let us discuss the FIFO method now. Now, under the FIFO method, sales under FIFO, because under FIFO, what is assumed? That the items which came first will be sold first. That's it. It doesn't care about the specific batch. Okay. So if the total sales is 5,800, think about it carefully. If the total sales is 5,800, it has to come sequentially, basically, unless and until, I mean, you continue from the first batch until you hit this 5,800 level, the total level. So can you tell me under FIFO, will the entire first batch be assumed to be sold? Under FIFO, will the entire first, yes, very good. So this entire first batch will be assumed to be sold. Okay, so yes, this is okay. Okay, under FIFO, will the entire second batch be assumed to be sold also? Yes, perfect. So this is also true. Will the entire third batch also be assumed to be sold? Perfect. Yes, this is also true because even till the third batch, we are not reaching 5800, right? What about the fourth batch? How many items from the fourth batch will be assumed to be sold? Let us also calculate how much total was bought so that, just by looking at this number, it might make your job easy. So total 7,000 was bought. Okay. So can you tell me from the fourth batch, how much will be assumed to be sold? Quickly tell me. From the fourth batch, how much will be assumed to be sold? Very good. 300 only. Perfect. Okay. Because finally, the total number of units which is sold has to be same, right? 5800 only. Only if this is 300, then the total can be 5800. Very good. Very good. Okay. So 5800 units have been sold under FIFO. But uh, will the total revenue change under FIFO? No. Total revenue will not change under FIFO. So we don't need to worry about that. Now, this is the sales under FIFO. So what is the cost of sales under FIFO? This is the sales in units under FIFO. So what is the cost of sale under FIFO in dollars? Now tell me, to get this cost, which two numbers, which two cells should I multiply? Which two cells should I multiply? B and C. No, 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 no. Cost of sales. Cost of sales under FIFO. Under FIFO. 1000 units from the first batch, it is assuming 2000 units from the second batch. No, not B and C. Think about it, Karthik. B and C or H and C. Think about it, Karthik. B and H are different. Got it? For specific identification, it was okay. Got it? Okay. So that is why even though the first three cells are the same for H and B, but this is the issue, right? We cannot multiply. This was actually, B was the number of units purchased actually. Even for specific identification, we could not use it. For specific identification, we were using E. For FIFO, we are using H. Okay. So is equal to, what will I write? 1000 multiplied by C, the cost, right? Price per unit. So this is the cost of sales under FIFO. Okay. And obviously, what is the total cost? Let's see. What is the total cost of goods sold under FIFO? It is 45,300. It is 45,300. So you see a difference. You see a clear difference over here. That now under FIFO, your cost is a little on the higher side. Can you explain why? As compared to specific identification, you can see that the cost is a little on the higher side. Can you explain why? Very good. Prices are decreasing. So since prices are decreasing, FIFO is taking the cost from which prices? The first prices, right? FIFO is giving more importance to this price, correct? In terms of cost, right? Very good. Now, what will be the gross profit? What will be the gross profit under FIFO? What will be the gross profit under FIFO? Which two cells do I need to subtract? Quickly tell me. Which two cells do I need to multiply? C10 minus I6. Perfect. So C10 is the same. Total revenue is not changing. Absolutely correct. Because these methods, they are not affecting your revenue at all, right? So revenue minus cost of sales under FIFO, which is I6. Perfect. So this is actually 41,700. It is 41,700. So this is the cost of sales under FIFO. Now let us come to LIFO. Okay. Let us come to LIFO. In fact, after FIFO, let's go for that weighted average method also we can go for. Okay. In fact, weighted average we'll do towards the end so that we'll just see the numbers are in between. Leave it. Let's do LIFO. So under LIFO, what is the sales in units and what is the cost of sales in dollars? Let's calculate that. So first, tell me how the batches will be separated in terms of the number of units. For LIFO, how the batches will be separated in terms of the number of units. Tell me. Think about it. Let's start with batch 3 because batch 4, sorry, this is the last batch, right? Batch 4 is the last batch. So let's start with batch 4. Batch 4 will be assumed to be sold completely. Agreed? Correct. Last batch to batch 1. Absolutely. So for batch 4, it will be the same 1500, right? What about the next one? 2500 again. Correct. What about the next one? What about this one? You're already at 4000. How many more you need to sell now? You are already at 4000. How many more you need to sell? Very good, 1800. So now we cannot say equal to B2. No. So equal to, now I'll have to write 1800, right? Okay. 1800 directly. And what about the first batch? Will anything be assumed to be sold from the first batch? No, zero. Very good. So zero. So obviously the total number of units which are sold has to be 5800 without any doubt. So it is still 5800. Okay, now let's come to cost of sales. So again, I need to multiply the sales by the unit price. The sales by the unit price. So price per unit is same. Okay. So 0 and then I drag it. So this is the cost of sales under LIFO. And what will be the total cost of sale? What will be the total cost under this LIFO method? So I think I cannot give a label. I've already written 5800. But just like I gave a label over here, total cost under SIM, this is actually total cost under FIFO. This will be total cost under LIFO. Okay. I can insert columns or I can write it in the bottom. It's okay. But I hope everyone understands it, right? I don't need to write it. Is equal to sum of. So just, although you know the numbers, you see you can calculate easily, but just from logic, tell me this number should be greater than 45,300 or less than 45,300. What do you think? This number, according to you, should be greater than 45,300. So greater than, very good, less, perfect. Okay, because it is considering the recent costs first. And given that in this question, the recent costs have decreased. So my cost of sales will be less. Okay. So 40,900. What about the gross profit? Obviously, it will be higher. Tell me which two cells I need to subtract. Which two cells I need to subtract? Okay, Karthik. You've done the subtraction directly. So just tell me which two cells have you subtracted? C10, perfect, minus this time K6. So I get 46, 100, perfect. Okay, so you can see the difference. So this question can be, just by looking at the numbers, I think now it should be so clear in your mind that, because the question may not be asked directly about, the cost only. They can ask gross profit also. So in which case the gross profit is higher or highest, you can say. In which case the gross profit is highest? In case of a deflationary environment, yes. So remember, not always LIFO, but in case of this question where the environment is deflationary, where the prices are decreasing. So when the prices are decreasing, LIFO gives you the best gross profit and FIFO gives you the least gross profit. But the opposite will happen when the prices are actually increasing. Okay. Now let us quickly just do this weighted average method also. Okay. So for weighted average, the the uh, cost which will be allocated under weighted average, it will simply be a weighted average of all the costs. So it is actually quite simple. I mean, we don't need to do a weighted average every time because we already know the total number of units which were purchased. We already know that the total number of units which were purchased and the total cost. If we calculate the total cost, I mean, let's calculate the total cost. So total cost was how much? Sorry. Okay, so instead of doing this 1000 multiplied by 10,000, of course we have Excel, so we can just do the total cost and we have the total quantity which was purchased. So can I simply say that if I just want to have the cost per unit under this weighted average method, it will be the same, right? It will not depend on batch to batch. So I can do it separately. So under the weighted average cost method, let's call it WACM, weighted average cost method. Can I say, I'll just reduce the font size a little bit so that it is just visible on the screen. So can you tell me what two cells should I divide to get the cost per unit under weighted average quickly? Which two cells? Exact cells, Karthik. I know I need the cell number. Yes. So D6 by B6. Absolutely. This total cost divided by total number of units. So the average cost, the weighted average cost comes out to be $7.5. Okay. So if this is the cost per unit, then what is the total cost? What is the total cost under WACM? So again, which two cells do I need to multiply over here? I just need to multiply two cells. Tell me which two cells I need to multiply. Perfect, perfect. Quantity by price. So this is my weighted average total cost now. Okay. And as expected, it is between FIFO and LIFO. As expected, it is between FIFO and LIFO. Okay. And of course, what will be the gross profit under this weighted average cost method? What will be the gross profit under this weighted average cost method? Which two cells do I need to subtract? Obviously, the total revenue is not changing. Again, correct. C10 is the same minus E12. So this is my gross profit under the weighted average cost method. Okay. Now let's talk about one more number, one more parameter that we have to make sure that we calculate and write the value also correctly. Ending inventory. So in terms of the number of units, there will be no difference in any method. If you talk about the ending inventory number of units, okay, that will not change. I hope it's visible to everyone. I'm reducing the font size again. So if I talk about ending inventory number of units under all method, so ending inventory units under each method, will it change? Obviously, it will not change. How much is the ending inventory units? Again, which two cells I need to subtract to find out the ending inventory number of units? Number of units of ending inventory if I want to have, which two numbers I want to subtract? Perfect. Is equal to the total number of units which were bought minus the total number of units which were sold. So again, the problem is that this cell is a number, so I'll just reformat it as general number. Okay. So this is my total number of units which will be remaining under each method. That will not change. Okay. But obviously, for ending inventory, all these methods in terms of dollars, they will be different. Now, either you can calculate it, either you can calculate it one by one for all methods, or we can directly infer from the total cost and the cost that we have and the initial purchase price. Because see, what I said that the total amount of inventory which was available to for sale, it has been now divided into two parts. One that has been sold and one which is left. Okay. So total amount which was available for sale in terms of cost, you know that the total price that you had to pay was $52,500. You know that that is the price that you had to pay, $52,500. Okay. And the individual batches also, you know the price. So either you go for the individual batches and then you can calculate for each one ending inventory. I mean, I'm just giving an example. Suppose if sales under LIFO was zero for this particular batch, it means that in ending inventory under LIFO, I'm just writing it over here. So I'm giving you both the two ways. So ending inventory under LIFO, okay, in terms of course, units, this is how much in for LIFO. What is the ending inventory for this? If the sales of this batch is zero under LIFO, so what is the ending inventory? Which two cells do I need to subtract to find out the ending inventory? Tell me. Which two cells do I need to subtract to find out the ending inventory under this method? Very good, excellent answer. Is equal to the initial inventory minus the amount of inventory which was sold, okay, from this batch based on this method. So we have the full 1,000 units which are remaining. And if you drag it, you will have 100, 200, 0. Obviously, the total amount of inventory should be 1,200, which is the same over here, 1,200 in this case. Okay. So if suppose you want to value of the ending inventory, as I said, you can do it one by one. So I'm showing you just one example of one by one under LIFO. But then I will show you how to just calculate directly also. We can just apply some logic. So value of the ending inventory, let's say if I'm doing value of ending inventory under LIFO in dollars, this is coming out to be how much? Again, which two numbers do I need to multiply? Which two cells do I need to multiply? M is already there, right? L, Karthik, right? L1, na? Right? So L2, in fact, in this case, because 1 is already the header row. So L2 multiplied by C2, right? So we are getting 10,000. Okay, so we drag, we get this much, and the sum of these four will be 11,600, which is expected. Now, can you tell me, basically, we have done one thing. We have divided it into two parts. Think about it. What did I say? I don't need to calculate it one by one because every single time, if I just want to calculate the value of ending inventory, this total value, every single time I can just simply subtract the total cost minus cost of sales. Makes logical, right? Because if you subtract 52,500 and 4,900, so basically you want to subtract 4,900 from 52,500. What are you getting? 52,500 minus 4,900. What are you getting? Exactly. So it's the same value, right? So do I need to calculate it one by one like this? The total value of the ending inventory? Or I can simply do total cost minus the cost of sales. Is it clear? Is it clear to everyone? Got it? Okay. So you can do it yourself. In fact, you can now complete this Excel on your own. You can do it yourself. Okay. So that is the main idea I think that we should actually do in today's class. Okay, because the reserves and liquidation, all these things which although it is there in the PPT. But as of now, we'll refrain from studying it unless it is going to be used extensively later on. Okay, or from an analytical point of view, it is extremely important. Till that time, you can just skip that part. But these are the main parts that you need to concentrate on, because the questions can be asked that if the environment changes, if it becomes deflationary, inflationary from deflationary, what will happen? Okay, now let us go back to our PPT. Now let's discuss periodic versus perpetual systems. Okay, so there are two ways the companies can record the inventory. Okay, either it can be periodic or it can be perpetual. So let's start with the periodic system. So under this periodic system, the inventory will be valued at the end of the accounting period rather than being updated continuously over that period. Okay, so the purchases are recorded in a purchase account. They will not be recorded directly into the inventory account. They will be accumulated in a purchases account or purchase account. Okay, so the accounting system is actually tracking the purchases. Okay, but it is not constantly updating the inventory balance. It is there. There is a separate purchase account where all the purchases are going, but it's not coming directly in the financial statements. Okay. Now at the end of the period, when suppose we have to build this table and the asset and everything, we have to just enter the values of the total goods which are available for sale. Then the beginning inventory plus the purchases plus the goods which are equals the goods which are available for sale. Okay, the beginning inventory plus the purchases equals the total amount of goods which are available for sale, and physical count will determine the quantity. So to find how many units are remaining, obviously the best method is physical count. The count will establish the ending inventory quantity, and then whatever valuation method you can use, that can be applied to assign the cost to those ending units. Okay, and once you have the ending inventory which is valued, then the cost of sales can be calculated just residually. Just in fact, this is the opposite of what we did in the Excel sheet. We actually calculated the ending inventory value by subtracting the cost of sales from the total cost that we have, which was the total amount of inventory available for sale, right? 52,500 was the total amount of inventory which was available for sale in the beginning, minus the total cost of goods sold. We subtracted it, and then we got the value of the ending inventory. Over here, we get the value of the ending inventory. How? We calculate we count the amount of ending inventory physically. Then based on whatever method we chose, LIFO or FIFO, whatever, we assign the inventory cost, ending inventory cost, and then we do the opposite. We do total cost, okay, or total amount of inventory which was available initially, minus the ending inventory. That will give you the cost of sales or cost of goods sold. Okay, so I'm just writing it down. So cost of sales, when we write, it is calculated residually. It means that COGS is calculated as the cost of goods available for sale. Okay, this one minus the ending inventory level. Okay, minus the ending inventory level, or the uh, you can say ending inventory only, ending inventory cost or ending inventory, the ending inventory value. That will be better. Okay, fine. Now let us come to a perpetual system. Perpetual system is basically continuous inventory tracking. You have real time cost of sales update, real time cost of sales update, and the transactions are recorded immediately. Okay, the transactions are recorded immediately in this case. So as the transactions happen, they will be recorded immediately. So what is the benefit? The benefit is that the management will have, you can say, more visibility, more timely visibility, you can say, okay, into those inventory levels and the cost of sales also during that period rather than waiting for the full period end. Okay, now let's just try and connect the systems with the methods. Okay, we have the perpetual and periodic systems, and then we have those LIFO method, FIFO method, all those things. So FIFO and specific identification will be actually same under both the perpetual method as well as the periodic method. Okay. A periodic system can widen FIFO versus weighted average cost differences. Okay. So FIFO and specific identification will be same, but this FIFO and weighted average will be quite different. Okay. And periodic system can actually widen that gap. But perpetual system will make FIFO and weighted average cost more similar. Okay. LIFO will be different under periodic versus perpetual system. So uh, under LIFO, the systems will not produce, of course, the same allocation. Without any doubt, the idea will be different. But in this case, the numbers also, it's not that in this case the gap between LIFO and weighted average is higher or lower. That is not being talked about. It is just mentioned that under LIFO, the periodic and perpetual systems will generally not produce the same allocation. That's it. Okay. Okay. Now, as we discussed, under inflation, what will happen? Under inflation, FIFO will actually lower the cost of sales and which will result in higher gross operating profit. That was an example of deflation, remember. So, in case of deflation, what was happening? In case of deflation, profit was actually higher in FIFO, but in case of inflation, profit will be lower in EFO, whereas ending inventory will be higher in case of inflation. Okay, LIFO will be the opposite. So I think this is quite clear when you just recollect that particular example. The deflation we have already done. Okay, so this thing I'm not going to discuss once again. Now there is an insight under replacement value. So the FIFO ending inventory, it will be closer to the current replacement cost. Makes a lot of sense, right? Because that is what ending inventory, since it is reflecting the latest purchases, obviously it will be closer to the current replacement cost. Okay, so in the exam they can ask questions not in terms of the latest cost, but in terms of the current replacement cost. So yes, you will say that in terms of the current replacement cost, FIFO ending inventory will be closer to it because it is actually reflecting your latest purchases, that ending inventory level. But for LIFO, cost of sales will be closer to the current replacement cost. So that's the main difference between the two. So the terminology can be tweaked in the exam. Okay, and the same question which we have discussed through the Excel sheet, the same example, it can be asked in multiple ways. They can use the word replacement cost, they can compare it to ending inventory, they can compare it to cost of sales, they can change the method FIFO, LIFO. Okay, so be very careful what you are reading. That has to be very, very clear in your mind. And this is the last slide we are going to do today. Then, and we will also discuss, we will try to, because that I believe that perpetual and periodic system, I think it will be more clear if we can discuss one example related to that also. Okay, so after this, we'll just close it with that particular example. Now, what are the effects, tax and financial statement effects? Again, they just can be inferred directly from the results that we got on from the Excel. So we can just understand which method the company might prefer sometimes. Although LIFO is not allowed under IFRS, but let's say if it is allowed, and under US GAAP it is allowed, right? So under US GAAP, if the companies have all the options, what will they prefer? Now, if the costs are rising, Okay, it will actually reduce the taxes via higher cost of sales. So again, the idea is the same. If profitability is lower, that is what we saw. In case of an inflationary environment, in case of an inflationary environment, when prices are rising, when costs are rising, then firms may actually choose LIFO because LIFO is assigning the cost of sales a higher number based on the recent costs. So cost of sales becomes higher, gross profit becomes lower, and when gross profit will is lower, what will happen to the taxable income? Obviously, it will be lower. Okay, so lower taxes will increase the operating cash flow and they can raise the firm's value. And lower ending inventory can reduce the working capital, assets, and equity. So there is a trade off, although. I mean, yes, there is a benefit. Cash flow timing is a benefit. Okay, you are paying lower income taxes. The company is keeping more cash in the current period only, remember, because obviously it is going to reverse. Any advantage that you have got using LIFO now, obviously it will be reversed later on. So in the current period, at least the company is keeping more cash. Okay, so higher net cash flow you are getting from operating activities. Okay, operating cash flow is higher. And since the value of the company is, uh, when we cover equity chapters, we'll find that one of the very basic methods to value equity is basically the DCF method. Okay, to value a company, this discounted cash flow method. Basically, we find out the present value of all the future cash flows. So we know that under LIFO and FIFO, the total cash, I mean, the total cash flow will has to be same, right? If the environment is inflationary or deflationary, finally, whatever benefits you are getting now, they will be reversed later, or whatever losses you are getting now, they will also be reversed later. But then what is the advantage of having this benefit now? The advantage is that the overall present value of those future cash flows, the total cash flows becomes higher because the higher cash flow which you are having now, it need not be discounted because you are having it today only. But then if you use FIFO, you get a higher cash flow later on, but then it has to be discounted. So in terms of present value, higher cash flows today from LIFO, it actually increases the firm value. Okay, of course, assumption is that the firms have to reinvest those cash flows. That is one of the assumptions. But yes, theoretically, it can increase the firm's value. But there is a problem in the balance sheet now. You have a higher cost of sales, yes, but then you have a lower ending inventory also. So ending inventory, as we discussed under LIFO, is assumed to be the ones which were purchased the earliest, the oldest units. Okay. Now, since the costs have now increased, the costs are increasing, and typically that is the assumption that they increase over time. Those older units, they actually carry lower historical costs. Okay. So what will happen to your total reported assets on the balance sheet? What will happen to the total reported assets on the balance sheet? If the total ending inventory, which is an asset actually, is lower, what will happen to the total asset? Obviously, it will be lower. So yes, you have a positive effect on the cash flow statement, especially operating cash flow. You have a positive effect on the income statement in terms of gross profit. Definitely, yes. Of course, revenue is not changing. But then there is a negative impact on the balance sheet. Your overall asset is actually, or at least in terms of reporting, the assets look lower, right? Okay. So if the assets are lower and inventory is a current asset or non-current asset, tell me. Inventory is a current asset or non-current asset? What we assume? What have we done till now? What have we done till now? Inventory is a current asset or non-current asset? Come on, we have done this in the last class. Yes, correct. It is a current asset. Yes. It's very rare that inventory will be a non-current asset. Those are very rare cases. Okay. It will be very, very, extreme excess inventory if you're having or very slow moving inventory, then you can say that, yeah, it can be a non-current asset sometimes. But generally, inventory is a current asset. So if current assets are lower, what will happen to your working capital? That will also decrease. And what will happen to your leverage? Because assets are decreasing. So it means if liabilities are same, equity is decreasing, it means. Right? So what will happen to your leverage? Think about it. Yes. No, liability, don't say liability will increase. No, no, no. Liability stays the same, Vivek. Assets decrease, liability stay the same. So to balance the equation, equity has to decrease. Okay. So if equity has is decreasing, D by E overall will increase because D is the same. Got it? So your leverage will also look a bit higher. So those ratios will not be great. Okay. So that is important. The ratios will not be great. If the current ratio, the leverage ratio, those things will not be great because now equity is lower while the debt levels are actually unchanged. So ratios will shift to lower liquidity and profitability with higher leverage. So profitability ratios in the future will become low, liquidity ratios will be lower, leverage will become higher. Okay. And obviously, if costs are falling, then all these effects are actually reversed. If the costs are falling, then all these effects are actually reversed. Okay. So that's it. I think for inventory, this is what you need to understand till now. Nothing more than this. As I said, just one example we can do of perpetual versus periodic inventory systems. Okay. So uh, I think let's just go back to the Excel. Let's try. I mean, we'll actually have, because in perpetual systems, we'll have to consider a range of dates first. Okay. And then only we'll be able to understand the difference between the two. That exactly what happens, what will be the change in the ending inventory, what will be the uh, change in the COGS. Okay. And under perpetual, or see, the method and the systems, they are two different things. Systems means we are comparing perpetual versus periodic. And this method means we are deciding which cost flow assumption to choose. So perpetual versus periodic is basically about the frequency of recording. Okay, whether you are recording it continuously in the balance sheet or you are just having it separately as a purchase account, and then you are recording everything at the end of the period. That is known as periodic if you're recording everything at the end of the period. But if you are recording everything continuously, that is your perpetual method. Okay. So let me just go back to the Excel. I think we'll have to make a lot of assumptions here. If we want to continue using this example only, what happened to draw? annotation. Yeah, let me just see if we can create an example over here only. Let's say this company, in the context of this company only, if we want to have the perpetual versus the periodic system. Okay, I'll just give you a brief what exactly happens. Suppose we know that purchases will happen in batches, in 4 batches only throughout the period. Okay, but will the sales also happen in batches? In general, what is sales will happen continuously, right? I mean, on specific dates, of course, not every single point in time, but sales cannot happen exactly on the same frequency as the purchases. That is not possible. So what we will have to do, we will have to divide these number of units based on when the sales took place. Okay, so let's say the financial years is we are talking about, say hypothetically, we are talking about from January to December. For this company, if the financial year is from 1st of January to 31st of December, let's say. Okay, so on the first week of January, okay, today is 24th, right? Let's say 24th of January, it purchased this first batch. So let me just write. This happened on 21st. Let me add a date. So let's say this happened on 24 Jan. Okay. Then the next purchase, let's say, happened on, say, 5th of April. Okay. Next purchase happened on, randomly, we can take any dates. Say 17th August, let's say 17th August. And then we have the last purchase happened on say 12th October. Okay, like this. But the sales can happen in between, right? Maybe between 24 January and 5th April only, the first sale will happen. And in fact, instead of 26, let me just write 25. Okay, it's from last year, let's say. Because we know the date of sales also. So let's assume that the sales are happening in between. Okay. So let me just um, okay. So over here we have, let's say, 1 or 2 sales, then one sale. Okay, one sale. Let's say 2 sales here. Let's say, and then again 3 more days of sales were here, and after 12th also there is 1 more day of sale. Let's say, okay. The problem is that if I write the numbers over here, these sums C2 to okay, this has already changed now. So I'll have to actually add a separate column for sales. Okay, so let me just add a separate column once again. So this is date. The total units which were sold are 5,800. Okay, so let's assume that on 24th Jan, the purchase happened and the sale happened on 5th of, sorry, 11th of March, let's say. If we have already taken in April, I'm just don't want to take the same day. So doesn't matter, although we can take 5th only, no problem. So 5th of March, let's say we had 700 units sold. Now this does not depend on the purchase date. So basically We are just assuming that on 5th of March, the first sale took place of 700 units. See the impact, what will happen. Now, the impact will be, if suppose this is a perpetual system, whatever we did earlier till now in the Excel, that was a periodic system. So everything we were recording at the end. Now it is a perpetual system. So in perpetual system also, we have to first see which method we are using. In perpetual system also, we have to see which method we are using. So if suppose we are using LIFO, if we are using, let's say, LIFO, then what will be the inventory level at the end? If we have to determine that, then the first sale is easy. Out of 1000, 700 was sold. Again, I'm saying, I'm just giving you an idea of what can happen so that the concept is clear. Then we can just close the chapter. So 700 were sold out of this 1000. Now remember the difference. If we were using a periodic inventory system, then LIFO would not even consider this under sales. But since we are using a perpetual system, so even under LIFO, we have to now consider that whatever 700 was sold, obviously it is sold from the first batch. So is that idea clear? The main difference, what is exactly we are trying to do? Is the main difference clear? Okay, so this is the idea. Okay, so between LIFO and FIFO also, if the systems are different, then LIFO under periodic will give a different result compared to LIFO under perpetual. Similarly, FIFO under periodic will give a different result as compared to FIFO under perpetual. So let us try and build this one by one. So if you have 700 units which were sold and you want to have the ending inventory level on this day, okay, so you had, I mean, I'm just assuming that this 1000 was bought on 24th of January. So you have 20 on 24th of January, you have ending inventory as, I'll just call it as perpetual LIFO. Okay, so ending inventory perpetual LIFO 1700. How much is remaining? You have no choice actually. Right now, for the first case, it doesn't matter which method you are using, right? So that's it, 300. Okay, and then again, let's say you had a few sales after the second batch was bought. Now, of course, once you have the second batch, then your total number of, you now see the difference. Now, once you have the second batch, yes, your ending inventory level is 2300. Okay, 300 plus 23, 300 plus 2000. But here, under LIFO, now that now it will be last in, first out. So your next sale which will go, let's say the next sale, it takes place on 21st of April. Now we can understand the difference very clearly once we have the second case. And now let us assume that on this day, 1500 units were sold. Now tell me, 1500 will be comprised of how many units from batch 1 and how many units from batch 2? 1500 will comprise how many units of batch 1 and how many units of batch 2? Tell me. Just give this answer and then you are through. You will be able to understand it. And if a detailed question also is asked in the exam, you will be able to solve it quickly. The second sale, which is happening on 21st of April, my question is, How many units is being assumed to be sold from batch 2 items, which contains 2000 units, and batch 1 items, which contains 300 units? Tell me. If this is clear, then everything is clear in perpetual. 1500 units. How many from batch 2 and how many from batch 1? Quickly. Out of this 1500, how many from batch 2 and how many from batch 1? It is LIFO. Last in, first out, but a perpetual system. Excellent answer. Simply 1500 from batch 2. It absolutely correct. Okay. So this 1500 will be actually sold completely from batch 2. So now how much is remaining on 21st April? How much is remaining with you? Total? Total, how much is remaining? Very good, 800. And this 800 is comprised of how many from batch 1 and how many from batch 2? How many from batch 1? How many from batch 2? Ending inventory. So now the calculations will very good. Excellent answer. So 500 from batch 2 and that entire 300 from batch 1 are remaining. Very good. Perfect. That's it. Okay. Fine. So yeah, that's it for today. So we'll just end the session now.